Welcome to the deep dive. Today, we are going granular. We're looking inside the machine by analyzing the Q&A session from the Deckers Q2 fiscal 2026 earnings call.
And we really have to, because
Yeah.
Deckers, the company behind Hoka and UGG, they reinstated their full-year guidance. But, and this is the key, the expectations were noticeably lower than what they'd signaled before.
Exactly. It's a huge signal that something's shifted. So our mission today is to figure out what's driving that caution. What trade-offs are they making?
Right.
And what does it tell us about their long-term strategy for Hoka's insane growth and, UGG's resilience?
Well, if you really listen to how they answered the analysts' questions, you see this very deliberate choice being made. They're choosing to accept a little bit of slower growth right now to protect the long-term health of the brands.
So profitability over just pure top-line growth.
Exactly. Profitability, pricing power, and keeping that operating margin above 20%. That's the real story of this call.
Okay, let's unpack that right away. The new numbers versus the old framework. So before this call, the original plan, which kind of assumed no tariff impact.
Which is optimistic.
Very optimistic.
Yeah.
It called for Hoka growth in the mid-teens and UGG somewhere around mid-single digits.
And now, fast forward to today. The new guidance for the full year is a total revenue of $5.35 billion. But the growth rates are the key. Hoka is now pegged at a low teens percentage increase, and UGG is in the low to mid-single digits.
That's a pretty big adjustment when you're dealing with numbers that large. So what was the reason they gave? It wasn't about competition, was it?
No, not really. Management pointed to two big external headwinds. First, the tariffs. They're finally hitting in full force.
Okay.
And second, they're bracing for a more cautious consumer here in the U.S.
Yeah.
Basically, all the price increases from everyone are finally starting to bite.
That phrase, cautious consumer, for anyone following retail, that's the key. It doesn't mean people are stopping buying just. They're thinking a lot more about when they pull the trigger.
That's it, exactly. And for UGG, they said they're seeing deeper valleys and higher peaks in buying habits.
Which just means people wait. They wait for a holiday, for a big sale.
Right. No more casual Tuesday afternoon shopping. It's all concentrated around back to school, Black Friday, Christmas. It makes for very choppy data quarter to quarter.
Okay, but I want to circle back to Hoka for a second. Downgrading growth from mid-teens to low teens, that just sounds bad on its face. Is there a silver lining I'm missing?
There absolutely is. And this is a really critical insight from the call. Hitting low teens growth with the full tariff burden is actually better than they thought they could do under these conditions.
Ah, okay.
That original mid-teens target assumed a much cleaner, tariff-free world. So the fact that they're still putting up low teens numbers with all these headwinds, it actually shows the brand has more momentum than they expected.
That completely flips the script. The brand is overperforming its environment, even if it's underperforming the original best-case scenario model.
Precisely. It's a subtle but really important distinction.
So what does that mean for the second half of the year, the huge holiday season? How are they forecasting that?
They're being careful. They expect Q3 to be under more pressure, but then they're calling for more aggressive growth in Q4, a big rebound.
But is that just hope? I mean, the cautious consumer is still going to be there in December.
Let's call it conditional confidence. They believe their products are at the top of the list, so if the consumer shows up and spends, a lot of that money is going to come their way. They're betting on being a must-have item, not a nice-to-have.
Which makes how they manage their sales channels absolutely critical. Let's move to that. The balance between selling directly to consumers, DTC, and selling through wholesale partners.
Yeah, this is a big topic. In the first half of the year, they intentionally pushed more product into wholesale. Their retail partners were screaming for it. They wanted it early, and Deckers said okay.
And doing that lets them get, as they said, more shoes on feet. It's a market share play.
Right. But the trade-off is that it puts pressure on your own direct-to-consumer business in the short term.
So the softer DTC numbers weren't a sign of weak demand. It was a strategic choice.
Correct. If a customer can buy the shoe at their local running store, they might not go to Hoka.com. Management was very clear they expect DTC growth to pick back up in Q3 and then get even stronger in Q4.
And they're still committed to that long-term 50-50 split.
100%.
Right.
They see wholesale as crucial for scale and brand awareness, but they want that 50% DTC to control the brand message and, just as importantly, control their margins.
That control leads right into pricing. They raised prices back in July. With this cautious consumer, did they see any pushback? Any sign that they went too far?
It's fascinating. They basically said no. They believe their brands have more elasticity.
Meaning they can stretch the price higher without snapping demand.
That's the idea. Because Hoka and UG are seen as premium, people are willing to pay for them. They're not just buying a generic shoe, they're buying into a brand.
So they use that brand power to offset some of the tariff pain.
Exactly. And they were, in their words, very selective and strategic. They didn't just slap a 10% increase on everything. They focused on key styles. And they said the sell-throughs have remained just as strong. That confidence is a huge piece of this whole puzzle.
All right, let's get into the financials. Segment 3. The tariffs are the real villain in this story. What are the hard numbers we need to know?
Okay, so the total unmitigated impact for the year, it's about $150 million.
Wow! $150 million, that's a massive hit to the bottom line.
It's a gigantic number.
Yeah.
Now, they're not just sitting back and taking it. They estimate their mitigation efforts, the price increases we just talked about, plus some cost sharing with their factories, will offset somewhere between $75 and $95 million of that.
So they're cutting the problem in half, roughly. But that still leaves a net hit of, what, $55 to $75 million?
Yes, a very substantial impact. And that's why they went out of their way to warn analysts that the strong gross margin they saw in Q2 was a bit of a timing fluke.
Ah, a one-off.
A one-off. They said it was unique to the second quarter and that the real pressure from the tariffs would be felt in the back half of the year.
So with all that pressure, how do they still claim to be aiming for top-tier profitability? What does that look like?
It looks like an operating margin of 21.5% for the full year. That is their target.
Which, in the footwear and apparel world, is considered excellent.
It's top tier, especially for a company that's also investing so heavily in growth. And you have to remember, this isn't a one-year problem. They also confirmed the tariff headwinds will carry into the first half of fiscal 27.
So it's an 18-month headache.
At least. But their commitment to keeping that margin above 20% through it all, that tells you everything about how they're running the business. It's about disciplined, profitable growth.
Okay, let's switch gears to the brands themselves. This is where it gets really exciting. Hoka. They're talking about capturing billions of incremental global market share. Where is that coming from?
Well, they laid out 5 specific growth areas. It's not just about hardcore runners anymore. The buckets are performance run and trail, hike, fitness, lifestyle, and apparel.
Lifestyle is the big one there. That's the massive everyday wear market.
It's huge. And they were also really candid about some past mistakes. They actually called fiscal year 25 a learning year for Hoka's product launches.
You don't hear that kind of self-critique often on these calls. What did they learn?
They admitted they launched a few too many big products all at once in the first half of the year. It created, in their words, noise in the marketplace and messed up the inventory flow for retailers.
So their biggest threat wasn't another shoe company, it was their own launch schedule.
In a way, yes. So now they're fixing it. The next big update to the Clifton, for example, is being pushed to fall of 26. That way, it won't be competing for attention with the Bondi launch. It's about creating a smoother, more predictable cadence.
Makes sense. And what about UGG? How are they keeping that legacy brand fresh and growing?
2 things really stood out. First, men's footwear. It grew at twice the rate of the overall UGG brand in the first half. They see that as a major, major opportunity.
That's a huge perception shift for a brand that's been so female-focused for decades.
It is. And the second thing is their success with new styles. They're proving UGG is more than just the classic boot. The Mel franchise more than doubled. The new Classic Micro was a top 5 style right out of the gate. And they launched a ballet flat, the Zora, that's just blowing away expectations.
Ballet flat from UGG.
Exactly. It shows they can take that core brand promise of comfort and apply it to totally new, fashion-forward categories.
So when you put it all together, this Q&A really painted a picture of a very disciplined company. They're dealing with huge external pressures, but they have a very clear plan.
They do. They are choosing long-term brand health over hitting the biggest possible number this quarter. And that willingness to accept a slightly lower growth guide to protect that 20% plus operating margin, I think that's a sign of really smart long-term management.
At the end of the day, they're protecting the premium nature of their brand so they don't have to discount their way to growth down the road.
That's the whole game right there.
And that leads us to a final thought for you, the listener, to mull over. Deckers openly said that fiscal 25 was a learning year for Hoka because of internal missteps, specifically with their product launch timing. So it raises this question. When you're managing a portfolio of high-growth, high-demand brands, is your biggest threat actually the competition? Or is it the risk of your own internal fumbles, like a poorly planned product calendar, that can do the most damage? Something to think about until our next deep dive.